Hello, and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined by Alan Higgins. And Alan, this is going to be our last Need to Know for a while because you're taking a bit of a break from investments. What on earth are you doing?
I deserve a break. I'm actually,
You do.
thank you. Sad days. And thank you for everything you've done, Sarah. It's been wonderful. I'm going to go and live in the Alps for a bit. It's about
Really?
time I did that. Apart from just taking holidays, I'm going to go and live there for a bit.
You can't surf in the Alps, so Alan. What are you going to do?
That's true. Can't do that. But I think I'll find plenty of things to do. You know how much I like reading. And of course,
Yeah.
there's still a little bit of skiing. There's nice tennis, etc., etc., etc.
I was going to say there's got to be some nice tennis courts up in the Alps, isn't there?
Yeah, exactly.
Well, hopefully, we might get you back on again in the future. And if I'm ever Alps bound, I'm definitely going to be knocking on your door and saying, "Come on, Alan."
Yeah, of course. Very, very welcome. And any listeners, bring a tennis racket because I think the skiing season's it hasn't been the greatest.
Yeah.
It's coming towards the end.
I know you are actually a certified tennis coach, so maybe you can give me some tennis lessons because I am a terrible tennis player. So
Okay, well, I've got to qualify that. Okay, I'm the lowest level tennis coach ever, which literally almost anyone, and I mean people who can't play tennis, can get. Having said that, I am thinking of getting my level 2, but I'll have to be back in the UK for that. That is a bit slightly more demanding, but honestly, it means nothing.
Bearing in mind that I'm probably the lowest level tennis player you'll ever see, but we're probably about well matched then.
Yeah.
so that's that. And then the other thing is, I mentioned surfing already, and I think this is probably something we're going to pick up over the summer when it's a little bit quieter and everybody's minds turns more to sort of summer activities. We did get a message from Tom Anderson, who I think is going to finally put to bed this subject of surfing and the best surfing beaches, because he's written a book, hasn't he, which, if I remember correctly, is called Grey Skies, Green Waves, A Surfer's Journey Around UK and Ireland. And I think we'll have to get him on, won't we? Or I'll have to get him on, and maybe you can make a guest appearance and we can argue about Cornwall versus Wales.
Yeah, I'll fly in from the Alps, especially. Yeah, I mean, I think so. I did notice it has great reviews on Amazon, so it doesn't always mean anything, but I think it looks like a really good book. So I will actually. That's a nice book for me to take to the Alps, actually, amongst others. I've got to stop reading investment books. I've read it. I've given enough investment book reviews on this podcast.
Definitely. All right. Well, no, you haven't given enough, but they're always very welcome. All right, then. So 3 things. What are the 3 things we need to know then this week, Alan?
So back to usual, no reminiscing, although we did take on Michael Burry from The Big Short, didn't we? Very humbly, obviously a genius, absolute genius, but we did, over the last couple of years say basically no massive crash. However, look, I think it's quite interesting to look at central banks in the sense of what's happened to all the rate cuts. And in fact, we've had one rate increase from Japan.
Yes.
So let's look at it and a bit of discussion about that and kind of where have the rate cuts gone in the UK, the US, etc.
Yeah.
And then, Sarah, we covered it a year ago. 1 year on, Silicon Valley Bank.
Yes.
And Credit Suisse.
Yes. That seems like an age away.
It does. We could combine this into, but you forced me to do 3 things. So the first thing is central banks. So for putting these into 2 categories, I suppose we can go back in time. So I think in terms of an interesting perspective, it's fairly obvious. You may not remember why Silicon Valley Bank failed. A little less why Credit Suisse did, and what happened, repercussions, and then 1 year on, lessons. Fairly obvious lesson. I think didn't Monique Wong speak about lessons
she did.
in a previous podcast? We'll come, which is spoiler alert. You should have bought. And then where do these markets stand now? Because we always pride ourselves, don't we, Sarah? We try to be somewhat forward-looking, not just looking in the past.
We do, because there are some foolish people out there that don't listen to this the week it comes out. I don't know what they're doing.
Yeah, quite. I'm the same, by the way. I even listen to our own podcasts late, let alone other people's podcasts late.
Okay, you're excused. All right, then. So central banks. So, where have all the rate cuts gone? We got very excited. We had that big sort of Fed pivot at the end of last year. people were, markets were pricing in, I don't know, 5, 6 rate cuts in 2024. That seems to have dissipated now. We did, as you say, have the Bank of Japan actually raise rates. I mean, we're no longer in negative territory as far as the Bank of Japan's concerned, but put them to one side because they're a bit of an outlier. Where have all the rate cuts gone? What's happened?
Yeah, so it's good. So exactly. Well, stepping back a bit, we had that. It was a shock at the time. Do you remember with Jay Powell? I think yet again I made a mistake in saying, yeah, Jerome Powell's going to be speaking. It's going to be nothing very interesting. And what did he say? Rate cuts are coming, explicitly. Yeah. Policy's already too tight. It was a big shock and a big positive shock for the markets in November last year. So the market priced in 6. So I guess the question is, Sarah, why did the market price in 6 rate cuts to start with? By the way, similar kind of pricing in the UK. And the reason is, to be fair to all analysts, myself included, is that when the Fed has cut rates in the past, they tend to cut rates a lot. So people look back, and we do use history as a guide. And an analogy I think I'll bring into this is, and that didn't work, obviously, and it doesn't look like it's going to work, is, do you remember we had the big discussion about the yield curve inversion?
Yes, we did. That was the definitive, we're going to have a recession, there's a yield curve inversion, apart from our friend Anatol Kaletsky, who said that's all rubbish.
Yeah, you joined us with the meeting with Anatol, didn't he? And he said, you're all rubbish, especially you're here in the UK, because it doesn't work in the UK.
Yeah.
And yeah, I think there's a point. It's important to look at history, but there's also a point to interpret it in the current situation. And the yield curve signal did not work this time. Some people think it still may. And yeah, looking back at history, there were so few examples of Fed cutting regimes, if you like, that I think it was wrong, or obviously wrong, to price in so many. So where do we stand now? I'll give you it's basically 3 cuts in the US and the Eurozone. I'll call it 2 to 2.5 in the UK. So if you like, there's a bit more doubt in the UK. That's looking a lot more reasonable now, don't you think?
I do, yeah. I guess the question is, though, who's going to do it first? I mean, that seems to be where there's still a little bit of debate. I heard people seem to think the ECB are going to be first to cut, and that maybe Bank of England might be last.
Yeah, I think that's right. But because it's right, it's probably priced in, Sarah. And the reason is pretty simple. Eurozone inflation has fallen as sharply as anywhere, but they've also had recessions.
Yeah,
especially in Germany. Fairly mild recessions. Whereas the United States seems to be far away from recession, robust growth. And I just thought I'd say, what does that mean in practice? What does that mean in practice is that basically 2-year bonds, if you think of 2-year bonds, a 2-year bond is, if you like, rolling 8 chunks of 3-month money. Yeah. Technical term, eight 3-month deposits. And so if there is closely related. It just means that that 2-year becomes a bit more attractive. So, for example, in the United States, it now trades at 4.7%, which is less than cash. But you can see, you're thinking, okay, 4.7, if you like, rolls in 3 rate cuts from around 5.25 by the time you own it. That's the idea. The idea is that you kind of break even at that kind of level. So, I think we're in a pretty good place now. What is amazing, though, the stock market's held up despite higher yields and these glorious rate cuts going away. Because you and I have been on previous calls, and that when there's been fear of 1, higher rates, or 2, just the bond market selling off, equities haven't liked it either. So it's quite encouraging that the bond market is selling off, yet the equity market is holding in.
Yeah, I suppose, and we've always kind of known, I think we've certainly always talked about it within Coutts, that the last mile of that fight against inflation was always going to be the trickiest bit, wasn't it? It was that last bit before we start the rate cuts. And I guess, I know Monique mentioned this at a client event the other day, that central banks they don't want to have rate cuts and then have inflation suddenly bounce back again. So it's just, they're going to be absolutely belt and braces before they do it, aren't they? And I guess that's reflected now in this slightly different view from markets.
It's now reflected. I think that's right. I think Jay Powell took us so by surprise. There was euphoria, frankly. And so to put that in context, what does it mean? The 2-year Treasury's gone from about 420 maximum euphoria, 6 rate cuts coming, to 470, much more reasonable today. So I do want to add something on Japan, though, because it's 17 years since they last raised rates. Isn't that amazing? And finally negative rates have gone. And just what amused me is, well, the rates of interest you get. So from the leading banks, the current rate of interest, let's get this right, is 0.001%. 0.001. I mean, it's not even bother worth collecting it. It's now going to be the magnificent 0.02%. So if you have an account with Sumitomo, Mitsubishi, etc., that's all you're going to get. And but it's a big difference for banks, because banks have about $700 billion of reserves with the Bank of Japan, and they now are going to earn 0.1%. So I guess linking into what we're going to talk about in terms of banks, the big question is higher rates good or bad for banks? And I'm of the opinion absolutely good, unless the higher rates destroy the economy, or, as we'll come on to in terms of Silicon Valley Bank, unless your risk management has gone out of the window, dare I say. So Japanese equities are up 20% year to date.
Yeah.
So what do you think, Sarah? You know, I got to put you on the spot. Japanese banks an outperformer or underperformer? Dull Japanese banks, no tech, no AI. What do you think?
I think they are outperforming.
Well done, Sarah. You've got it. Not that much, but up 25%.
Yeah.
And maybe more to come. Because higher interest rates are just mathematically, they're getting paid more, and they're certainly not paying up for deposits. To repeat that, what are you going to get? You take your million yen to Sumitomo, Mitsubishi, etc., Mizuho, 0.02%. They're not paying up for these deposits. So Japanese banks look interesting to me.
Okay, all right then. So then, to summarize, then we've got all this sort of talk of rate cuts and 5 or 6 rate cuts. That's all kind of gone away. It now looks like we're going to get we're saying at the moment ECB and the Fed possibly 3 cuts this year, Bank of England possibly 2 cuts. I did see that the Chicago Booth poll, more than 2/3 think the Fed will do 2 or fewer cuts this year, with a kind of 50-50 split between whether the first cut's in July or September. So that seems to be the general consensus. Okay, so that's central banks. Next then, we want to talk on, it's 1 year on, just give or take a week or so, from, well, first of all, SVB and then Credit Suisse. And I guess we were going to talk, before we looked at what the current situation was, and 1 year on, where we are now. It was sort of what happened, what seemed like a potential banking crisis, but actually kind of didn't really materialize, did it? I mean, it felt at the time like, oh crikey, are we on the brink of something here?
It did, didn't it? But Monique had a great phrase, didn't she? She said, "This is not a banking crisis. It's a crisis for some banks."
Yes.
And that proved to be so accurate. And so I think it's quite interesting. And because, for people, okay, we focus on this all the time, but people may think, well, what made Silicon Valley Bank go bust, effectively bust, basically bought by First Citizens in an emergency deal? That is very clear. So, and I'll tell you. So basically, when rates were 0, the management, the executives decided, well, 1.5% on treasuries, US treasuries, is not much, but it's better than 0. Let's really load up. Now, to be fair, some other banks did that.
Yeah.
But today, treasuries yield 4 to 5%, depending on which maturity you're going to. So they basically took a huge bet. So let's say a 10-year treasury that they bought at a yield of 1% would have a price of about 80 right now. So the issue is, if you can hold it to maturity, not the end of the world. It's a long time, 10 years. And to be fair, it wasn't all 10 years. You will earn 1%. Not great, but you'll earn 1%. Yeah. But this is the issue. Your depositors have to stay with you. Because if your depositors move, you have to pay them out. And So people started to spot the unrealized loss on the balance sheet because it was unrealized. And if that hadn't been spotted in a way, then, then fine. And the other aspect to it, uniquely with Silicon Valley Bank, is that because it was the bank of Silicon Valley, including some huge crypto deposits, the deposits were huge, like billions of dollars, hundreds of millions of dollars. So it wasn't moving, your mind, couple of thousand around, and where there's millions of people like you and me with thousands. It takes a while to get some momentum going, but it didn't take long for these big deposits to move, and therefore when deposits move and you don't have the money, you have to sell the treasuries, and selling the treasuries at 80, that's a disaster.
I was going to say one thing. I was thinking about this. I wonder, a stark difference to the global financial crisis, how important was social media for this? Because, two things. One, electronic banking and the ability, and banking apps on phones, and the ability to move money very quickly, but also social media in the way that a message could be disseminated very, very quickly. This bank looks like it's in trouble. And I think that's kind of maybe what happened with Credit Suisse as well, where, if you think of 2008, Facebook was in its infancy. You didn't have WhatsApp, I don't believe. You certainly didn't have social networks with the size of audience that you have now. And I wonder how much of that was an impact of sort of spreading a little bit of panic amongst clients.
I think you're right that there was that, and also there was an old-fashioned element to it, because if I'm not mistaken, there was a big venture conference where this became a venture capital amongst founders and investors, and this became a big topic amongst treasurers and investors. And where's your cash? Is it Silicon Valley Bank? How much have you got there? All of it. It became a big topic. Are you sure it's safe? Kind of discussion. So, but yes, I think that definitely added to it. And however, underneath, there was undoubtedly a solid bank. And you may recall, do you remember who bought the UK bank? Because there was a UK version of Silicon Valley Bank, and for how much?
No, I've forgotten now. You have to remind me.
HSBC for £1.
Yes.
Okay, so it's all a bit hidden. Allegedly, it went well, but it's fairly clear who bought the US operations. First Citizens, 1 year on.
How's it doing?
Plus 170%.
Really?
So there's a lot going on at First Citizens, and I'm no analyst of First Citizens, but the stock market says First Citizens did pretty well.
Okay. So, I mean, at the time, there was a lot of discussion about how this was idiosyncratic. So what happened to SVB couldn't happen to other banks. It was completely different. We then had, hot on the heels of SVB, Credit Suisse. How are they completely different? I mean, I guess from what I've looked at it, it seems like they were completely different, because it seems to me the Credit Suisse issue was slightly longer in the making than SVB. Is that fair to say? There was a lot going on in the background with Credit Suisse, where there were a number of scandals over a number of years, allegations of spying, their link with Greensill Capital, and I don't know how you pronounce the other one. Is it Archegos Capital? How do you pronounce that?
You're probably right. I would say Archegos, but that's because I'm a commoner that has no knowledge of ancient Greek.
But there was some links. They were sort of impacted by the collapse of Archegos and Greensill Capital, weren't they? So there were a number of issues. But is it fair to say they were completely different situations and causes?
Yeah, I think Silicon Valley Bank was clear. And by the way, there were other smaller banks that ran into trouble, a couple crypto related, and there still are issues with US commercial real estate. Yeah, absolutely. So, but yeah, the big one, and this was the really big one, is Credit Suisse. And I think you're exactly right. It's hard to pinpoint one specific point, but just rolling losses, terrible losses. So you mentioned Archegos. I'll pick on that one. Okay. They lost $5.5 billion in Archegos. What was Archegos? Archegos, and if I'm pronouncing it wrong, I apologize to all the classic scholars out there. So it was basically a family office that had at one stage over $30 billion worth of assets, was ridiculously leveraged and ridiculously concentrated in individual stocks and lost everything. A guy called Bill Wang rang it, and he used leverage, and he used leverage from the likes of Credit Suisse, Nomura, Goldman's, Deutsche Bank. But this is the issue, okay? How much did Goldman's and Deutsche Bank lose from Archegos, having had significant exposure? Do you know, Sarah?
I don't know, but not as much as Credit Suisse.
Oh, right, zero. Okay. Good risk management, zero.
Yeah.
It's not often like we praise Goldman's and Deutsche here, but zero. In contrast, Credit Suisse lost $5.5 billion, and also had to rub salt into it. They had a fine of $400 million from the US and the UK authorities. So absolute disaster. And you mentioned some of the other issues, and it was a steady drip. And then you mentioned social media, and I think this did really get going in social media. One of their major shareholders, the chairman of Saudi National Bank, was asked, would he invest more capital in Credit Suisse? And he used the phrase, and you do wonder if the English was somewhat mistaken. He said, absolutely not. And this is a matter of fact, this is in the public domain. It was an interview on Bloomberg or CNBC, I think it was Bloomberg. And that really sent it into a tailspin. And then we had the extraordinary takeover from UBS.
Yes. Shotgun wedding, some people called it, didn't they?
Yeah. So just to cover that, and, we're working hard to split this into two. The most shocking thing about the shotgun wedding is that over a weekend, UBS agreed to buy it for about $3 billion. So equity holders got $3 billion. But then subordinated bondholders, COCOs, as they're called, tier one instruments, whatever you want to call them.
I was going to say, otherwise known as contingent convertible bonds. That's
right. There was about $17 billion worth of them outstanding.
Yeah.
The Swiss regulator wiped them out, saying they were insolvent. And that has caused a lot of controversy and sent that particular market into a real tailspin. And the reason is fundamentally, Sarah, is that the way is for banks, well, for any corporation, but banks that have this kind of capital structure, depositors are paid first, as you imagine. Senior bondholders that are maybe slightly subordinated, some of the new bonds paid second. Then these subordinated bonds, COCOs. I mean, there are some other subordinated bonds in there, but for simplicity, COCOs. Then equity. That's normally how it works. There was a Spanish bank, Banco Popular, that was taken over by Santander, and the equity and the subordinated bonds got written off. What was so unusual here, you're an equity holder, you got something. Great. But as a bondholder, no.
And in fact, those bonds were not converted into equity, were they? Which is what should have happened. They were not converted into
equity. They were not exactly right. They were just written off. And you know what? I'm going to give the FCA some praise here.
Oh, really?
Yeah, because I've given them a hard time, haven't I, on these podcasts? Okay, and so here it goes. Because I'm willing to be corrected, because I initially so COCOs, the FCA basically said individual securities not suitable for private clients, funds fine, and I'm going to come back to funds. So being diversified fine, if you like, but individual securities no. Whereas in Asia, there was no such restriction, and a lot of these Credit Suisse tier ones were owned by individual investors in Asia. And of course, lost everything in a concentrated position. Whereas for the funds either had zero exposure or modest exposure and was managed and diversified and absolutely sailed through. So actually, in a way, fair play to the FCA. It looks like they made a good call there. Although I'll put my hand up, and I didn't necessarily agree with it in the past. But yeah, much better to own a fund and be diversified than individual securities. But there's lawsuits going on right now, and people take both sides of it. I've read an interesting Oxford blog that said, people have got no chance in this in this because it's going to court in this fight to get some money for tier one holders. Others are saying no, it's completely wrong. How can equity holders be rewarded ahead of tier one holdings? But anyway, an absolute disaster, you might think.
Yeah, you would think
for the cocoa market.
Well, but it's not though, is it?
1 year on, people forget. Well, firstly, 1 year on, was it good for UBS? You think, Sarah, this takeover of Credit Suisse?
I think it was. I was looking actually at their. Well, no, actually, because if you look at their Q4 profits, they were down 64% over the previous Q4 of 2022. So no, it wasn't good for UBS.
They've had to. Well, you're true in the sense they've had to have some write-offs.
Yeah,
but actually, over the long run, and it's long enough, over a year, the stock market is king. And it recognizes the value and the franchise it's picked up. UBS stock is up 65% since then.
Yeah.
So your Credit Suisse stock became UBS stock. Okay, it's up 65%. And put it in context, because we talk a lot about tech stocks on here. Bank investing has been a good place to be. Eurozone banks up 40%, better than even US banks, better than the likes of JP Morgan. So again, going back to the Japan theme, higher rates in the Eurozone has been very, very good, in particular for Eurozone banks. Higher rates in the UK has been somewhat good for UK banks, but very, very good story. But Coco's is amazing. No one thought that market would come back.
No. It didn't take that long, though, did it?
It didn't. And the analogy I'm going to give you, I'm going to go back in time. When I was I would say a very young bond fund manager, but probably
this is when you were in short trousers, yes?
Yeah, very young. I wasn't that young then, but very young. The high yield market had its own own kind of, if you like, Credit Suisse moment. WorldCom.
Yes.
Ever vaguely remember that WorldCom?
No. Well, yes and no, but I have to say I did just remind myself. Yeah. It was the third, and it still is the third largest bankruptcy in US history, $104 billion.
Yeah, it was massive, and it was 2002. It was a long, long time ago, and the bonds were high yield, and they were considered quality high yield, a so-called fallen angel, and all kinds of repercussions came from that. There was Sarbanes-Oxley law in terms of protecting minority investors, where directors have personal liability. Arthur Andersen, sadly, sad demise. Always sad to see a demise, but I remember clearly high yield really hard to persuade clients and superiors of high yield. 3 years later, high yield bonds 50% higher, 17% compound from the high yield market from that WorldCom days. Yeah, and of course, no one even thinks about WorldCom. Okay, it was a long time ago, and the potential demise of the high yield market, and fallen angels. And it just goes to show the market can forget. So going back, so I do remember that. And look, firstly, I remember many investors saying we'll never buy another Swiss bank tier one. Well, in November, UBS issued one. Now, cleverly, either going to, or at least the intention to convert into equity, as opposed to not convert into equity, it issued a dollar bond with a coupon of 9.25%. So you earn 9.25%. Now, it is deeply subordinated. So if the same thing happens to UBS, that happened to Credit Suisse, that's cold comfort. These bonds are callable. So 9.25%. How does that sound to you, Sarah?
Sounds pretty good.
Yeah.
Not bad.
To your personal street. Well, you're not allowed to. The FCA got it right. You're not allowed to buy it. You have to buy a fund. Anyway, it now trades at 108. So investors have had the benefit of earning 9.25% a year. Yeah, that's a coupon, and now have an 8-point capital gain.
Yeah,
we like to be forward looking. Today, that trades at a yield of about 7.25. Okay. Why is it 7.25? Because that bond has to go from 108 to 100 over the next several years. So kind of the all-in yield 7.25. But for me, that's still not bad in an environment when rates are going back to what we said earlier, rates are going to edge down 2 or 3 times. earning 7.25% in a quality bank. Look how important UBS is, and this is just one example of a cocoa. So yeah, I mean, and overall the cocoa market, there's not very good indices on the cocoa market. It's quite a new index, but there's a number of funds, and this has nothing to do with the Coutts invested in them. I've mentioned funds on previous podcasts before, ranging from PIMCO, Blue Bay, Algebris, and you've had returns 1 year on of the order of 20% on PIMCO and over 30% on Algebris. So really, really stormed back. And I think the important thing of debt and high yield, they've got something in common. Sorry, the subordinated bank debt and high yield. They're superior. You know, I'm a big fan of equities, obviously, Sarah.
Yeah.
But you know, they are superior in equities in one way. So-called risk-adjusted return, Sharpe ratio.
Yes. Monique was talking about that, wasn't she, when she was on?
Yeah, exactly. But I will define it. I know we've got a lot of experienced investors on the call, so sorry to bore you, but it's basically return, so the return of the market minus the risk-free rate. So if you like the excess return divided by the volatility. So you divide out the volatility. So it's no good if you like something returning, well, it is good returning 10%, obviously, but if something returns 10%, but it's up and down 40, 50, 60, super volatile, it gets penalized, rightly so, right? I mean, it's less good in a portfolio. In contrast, high yield for a long, long time, and financial credit, which is you know, a shorter history, has a Sharpe ratio, so risk-adjusted returns, somewhat higher than equities. Not a lot higher, because equities are good. That number's around half, by the way. So yeah, this is a little bit of a secret source. It has been both high yield and financial credit has been in and out of Coutts portfolios over the many, many years. I was very, very pleased to make an allocation myself many, many years ago. But risk-adjusted returns, so attractive. Going forward, we use the example of UBS. Yeah, still not bad. Not as good as November last year, before Jay Powell went very bullish on us. But hey, it's not in November anymore.
Yeah. So essentially what we're saying then is, obviously, what this time last year, we did think we were on the brink of another banking crisis. It didn't turn out to be. SVB, very idiosyncratic, the causes for that. Credit Suisse, a little bit more complex and a lot going on in the background. But 1 year on, remind me of the name of the bank who took over SVB in America?
First Citizens.
Doing all right. UBS, doing all right. World's largest wealth manager outside of the US. Share price up. And if proof were needed, that investors and markets have very short memories. So all that talk about cocos, never touch cocos, won't go anywhere near them. And within a couple of months, or 6 months or 7 months, UBS were issuing cocos and people were buying them. And, you know, WorldCom, for those that remember, was sort of some people thought it was the end of high yield, but actually it wasn't at all, was it?
It wasn't. And kind of related to this, we should probably do a shout out for that, the podcast we did with Monique on buying corrections.
Yes.
Because there's a lot of people talk about buying corrections in equities. I don't know if you can remember the dates.
It was the 5th of December.
Yeah, but a big emphasis on buying corrections in credit. And analogous to this, I'm a big fan of that. I would say obviously, but not necessarily obviously. But again, what is the best risk-adjusted return? So you're in the midst of a correction. And by the way, we're long overdue a 10% correction in equities. You're in the midst of correction. So equities correct, high yield correct, financial credit corrects. What has the better Sharpe ratio? Or what is the better trade, if you like? You should buy into credit, interestingly. It has and that all be revealed on, what was that date again? I was listening.
5th of December.
5th of December. Listen to that on the 5th of December. And Monique, I think, did Monique put some numbers on it? Or did you just say, you know, the better Sharpe ratio is definitively buying into high beta credit?
I can't remember now. I'd have to listen again.
Well, you know what? If she didn't, she needs to come back on and put some numbers on it.
We'll definitely get her back on.
Yeah.
All right, then. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Alan, it's been an absolute joy working on Need to Know with you. This was a kind of baby born between us. That sounds a bit odd, but you know what I mean? We kind of came together and created Need to Know. It's been an absolute pleasure. I've learned so much working with you. I even don't mind when you put me on the spot and ask me awkward questions and I scrabble around trying to find the answer. And I've loved talking about Birkins and Wimbledon debentures and art and synthetic diamonds and all that kind of thing. It's been fabulous. So thank you very much, Alan. Thank you for everyone for listening and for your comments, suggestions and feedback. It's all very, very welcome. I'll be back with David Broomfield and more Need to Know next week. Until then, bye for now and bye, Alan.
Thank you, Sarah, so much.